Hello traders! In the following presentation I will share with you how I love to trade FX news events. But unfortunately we first need to go over the much dreaded disclaimer. General advice disclaimer. This presentation is aimed to be educational in nature and should not be solely relied upon as a recommendation or invitation to enter into a particular transaction or to apply a particular trading strategy. You should not engage in trading unless you understand the nature of the relevant markets, the rules and application of these rules to the strategies you are trading, the products and the full extent of your exposure to risk of financial loss. In any case, you should seek professional advice. The information contained in this presentation and on our websites has been prepared without taking into account the individual circumstances, objectives, financial situations or need of any particular person. And because of that, every person should, before acting on the information, consider the appropriateness of the information in regard to the individual circumstances, objectives, financial situation and needs. By watching this presentation you do so at your own will, and in doing so waive liability to any claims against the host, presenter and any associated organizations and people. Cool, let's get started. So following I will show you 3 strategies to trade FX news events with relative safety, and they are hedging with market orders, hedging with limit orders, and my favorite, the spike trade as I call it. And these strategies provide you with tools that help you to better manage the risk of loss, especially helping you avoid being caught on the wrong side of the market. Let me demonstrate on an example what I mean with that. Now this is a 1-minute Euro-US dollar chart from the 25th of February 2013, just in case you want to have a look at your own charts. You can see how price jumped up sharply the minute the news got announced, so it's this really big blue candle, right? And then you can see how it reversed as sharply and continued to drop to the downside like a hot potato. And this is where inexperienced traders can get badly hurt. What causes losses in news trading is often the inability to identify false breakouts, so being able to identify when a breakout will continue or when it turns into a whipsaw, and then managing the trade whilst price is moving so incredibly fast. Now this is how this trade unfolded after the initial spike up. You can see the 1-minute chart was up here above the red line, and it continued to drop for another 7 hours, and if you hadn't kept your stop loss tight you would be in a bad loss or even have your account wiped out. On the flip side though, if you had played this trade really well, there was a great potential for profits too, right? Now in order to set you up with a great potential for profits, let's have a look at the first strategy, which I call hedging at market. You can see how easy it is to get caught in losing trade, right? And this is where hedging is great, because you don't really need to worry about which way price continues to move as you're prepared for both directions. Hedging in Forex means to have both sell and buy positions for the same currency on the same account at the same time. The only risk then is the price difference or the spread that you paid between the long and the short order. And because your exposure to the market is capped, your risk of how much money you can lose is also capped or predetermined. Just quickly, in case you're not familiar with the term, a market order is an order to buy or sell a currency pair at the prevailing market price that is to be filled immediately. A sell order placed at the market will be filled immediately at the bid price, and a buy order will be filled immediately at the ask price. So let me just show you how to apply this strategy. What you do is, about at least 30 minutes before the news release, observe the price behavior leading into the announcement and see if you can identify clear support and resistance areas, which in this case you obviously can. Now that we have plotted the support and resistance areas based entirely around the price actions that takes place leading into the announcement, we can begin to set our game plan. The one thing we know for certain going into a news announcement is that there will probably be a lot of volatility. Predicting which direction that volatility may move is what makes trading the announcement so difficult and also so interesting and rewarding. But because we can be prepared with hedging strategies, we don't really need to worry about it. We can set entry orders in both directions and then act accordingly. I find the strategy works best when price has been ranging for a while and you can actually draw a rectangle around the price movements with clearly defined upper and lower limits. If that is not the case, don't even think of starting the strategy. It will not work. It really has to be based on a range-bound market. Now, as you can see here, for quite a long time, the price has been ranging in a 25 pip range, so it has stayed range bound, as we call it. And just shortly before the announcement, that's this blue candle here, and the red candle is the actual announcement. So just shortly before the announcement, and only if price is in the middle of the range, which in this case it was, if price is on the top of the range or the bottom of the range, again the strategy will not work. So if price is in the middle of the range, you put on a long order and a short order at the same time. You then put a stop loss for your long order, about 5 to 25 pips, 5 to 15 pips I would say, just really depending on your risk management strategies, below the support area. And you put for your short order a 5 to 15 pip range above your resistance area. So let's have a look at how this trade actually unfolded. This is what it looked like on the 1 minute chart at the time of the announcement. You have this massive blue candle to the upside, and then once again price collapses to the downside, even with a massive gap, which you could see on the previous chart here, right? Now, fortunately in this trade the spike wasn't large. This spike here wasn't large enough to get out of this range. It stayed inside the range and then collapsed. So our long trade got closed out at our stop loss below the support area, and then our short trade just continued nicely. And this is how the trade unfolded. The entry long was at 1.02955. The exit long was at 1.02932. We had quite a lot of slippage. We had a 23 pip loss, but the entry short was 1.02935, and the exit short was at 1.02780, which we ended up in a 175 pip profit, which is quite great, right? And so net profit was about 150 pips. Now, of course, not every trade turns out to be that great, but you know, if you get a few of them a week, your bills are paid, right? A word of caution. There are actually three challenges with this strategy. Number one, when you set your orders, you have to manage slippage, spreads, and often sudden moves before the announcement. So sometimes it's a bit difficult to place your orders and to keep your spread tight. The second risk is that price gaps in one direction takes out your stop loss and reverses straight back into the other direction, back into the range, and you're effectively in a naked losing trade. If that happens, don't try to recover the trade. Simply take your loss and do it all again in the next trade. There are over 100 news announcements every week, so there's plenty of opportunity, seriously. And there is the third risk, which is the risk of human nature. The natural tendency, which we also call a human bias, would be to take the profits on the winning trade and trying to recover the losses of the losing trade. Now, this is not the idea of a hedge. Do not close the profitable trade and leave the losing trade open in the hope that price will rebound, okay? It can work sometimes, but in most cases it doesn't. So please be careful. Don't get yourself into trouble. The idea of a hedge is that you pay an insurance, you pay a little bit of a loss to have the opportunity to make a really big profit. I can tell you in 8 out of 10 times at least it works nicely. So really no point in trying to force things. Okay, let's have a look at our next strategy, which is hedging with limit orders. It's also called a straddle in options trading. A limit order is an order to buy or sell a foreign currency against another at a specific price at some time in the future when that price is met. As opposed to a market order, limit orders might not be filled if the market moves away from the specified price. Now what we do is, once again, we observe price leading into the announcement to identify potential support and resistance areas. But in this case, we base our news trading strategies on breakout of support and resistance, and therefore set limit orders on either side of the support and resistance areas, with the idea that they are only being triggered if a direction has been identified. Has been identified because it broke out of the range actually. Now here's another euro chart, I think it was, with showing price leading into the announcement. The difference here is that we had a 220 pip range, which is quite a big range, and this is why I chose the limit orders instead of the market order strategy. I use market order strategies when the range is fairly small, and limit order strategies when the range is fairly wide. Now let's have a look at how this trade unfolded. This was the range just before the announcement, actually quite a few hours before the announcement. It didn't do much, right? Now we placed an entry limit order to go long above the resistance line with our stop loss just underneath the resistance line. We placed a limit order to go short below the support line with our stop loss just inside the range again. And this is how the trade unfolded. Again, another beautiful, profitable trade. And yes, they don't always turn out like this, but once again, if you get one or two like this during the week, your bills are paid, right? And now we get to the third strategy, which is my favorite, which is called the spike trade. It's so straightforward and easy. Now what you do is you wait for the candle to finish as a doji. And they don't always do that, of course, but if they do, it's pretty much a no-brainer. Now that could be a 1 minute trade or a 5 minute. If the 1 minute candle closes as a doji, you take that. You don't wait for 5 minutes, obviously. You take a long, you put your stop loss right underneath the low of the doji and let it continue run to the upside. The same is applicable on the other way around. If you have a doji to the if the trade moved to the upside first and finished up as a doji and continues to the downside, a beautiful entry to go short with your stop loss above the high of the candle. That is how easy it can get. And I hope you got lots of value from this presentation, and happy trading.